How did Dodd-Frank impact proprietary trading? Imagine a world where banks could gamble with their own money, risking everything on risky bets that could threaten the entire financial system. That was the reality before the year 2010. The Dodd-Frank Act changed that landscape dramatically. It was a response to the chaos of the 2008 financial crisis, aiming to make banking safer and more stable. One of its key parts was the Volcker Rule, named after former Federal Reserve Chairman Paul Volcker. This rule was designed to limit how much banks could engage in proprietary trading. Proprietary trading is when banks buy and sell stocks, bonds, or derivatives with their own money, hoping to make profits from market swings. The problem was, this kind of trading could lead to big losses and risky behavior. The Dodd-Frank Act banned banks from most of these activities using their own funds. The idea was to stop banks from taking reckless risks that could endanger the entire economy. But the rule did allow some exceptions. Banks could still do market making, which is helping clients buy and sell securities. They could also underwrite new securities for companies, hedge against financial risks, or trade government securities. These exceptions were meant to keep essential functions running smoothly. When the rule was introduced, many big banks pushed back. They argued that proprietary trading was not the main cause of the crisis and that the rule would make trading less liquid and more expensive. Despite this, many banks responded by shutting down or splitting off their proprietary trading desks. They moved these activities into separate companies outside the main bank structure. This was part of a broader effort to reduce the risk that big banks could pose to the economy. The impact of the Dodd-Frank Act on proprietary trading was significant. It marked a shift toward separating risky trading activities from traditional banking. This change aimed to protect depositors and taxpayers from future financial meltdowns. It also encouraged banks to focus more on safer, more transparent trading practices. The rule pushed the industry to adopt better risk controls and increased oversight. Meanwhile, independent trading firms, which are not subject to the same restrictions, gained opportunities to grow. Overall, the Dodd-Frank Act made a clear statement. Banks should not gamble with their own money in ways that could threaten everyone. It was a major step toward making the financial system more resilient and less prone to crises.